welcome, ladies and gentlemen. It's my privilege and pleasure to welcome you to the PPS Retirement Forum, gladly hosted by ourselves. Well, it's a pleasure to be here. We've had great response to these presentations in Johannesburg and Durban previously, earlier in the year, and it's a pleasure to welcome Bruce Cameron, the editor of Personal Finance, and with close to, how many years, Bruce? Nearly 40 years. I was going to say 39, but I didn't want to leave the one out. 40 years of experience in financial services and financial journalism. And it's a real privilege to have you here, Bruce. Thank you very much for sharing your time at a particularly busy time with the budget speech yesterday. Just a couple of words for housekeeping. There are forms on your chairs to rate the presentation, which I'd like you to fill in before you leave. There will be drinks and snacks afterwards. There are questions to be filled in there. If you have questions for the panel after Bruce has finished his presentation, please write them down on there. We will collect them from you and we will answer those questions. Keep them generic if you will, please, because obviously this is not about your personal portfolio. But if you have questions relating to your personal portfolio with the PPS retirement annuity, etc., or anything to do with PPS, we have a number of our staff outside with direct access as well to systems, etc. So if you have questions, please direct them to those people outside. And if, of course, you have questions of a personal nature for the panel, we'd happily address those afterwards. I'm John Marsden. I'm the National Sales Director at PPS. And I'd just like to kick off with a very brief overview of the financial planning environment. And what we look at there is, of course, the 5 main problems in life, which I'm sure you all are familiar with, but most of us actually don't want to accept or the reality of. That's living with, dying without providing sufficient funds for your dependents, the problem of losing the capacity to generate your income, temporary illness, hospitalization, the ravages of inflation and tax, and of course, the topic for this evening, living beyond your earning years. And that's the crucial element, and of course each one of those is of critical nature. But what we don't often think of is what is our annual income generating capacity, and how does that manifest in terms of a lifetime of earnings? Because these numbers become absolutely scary, and we don't necessarily think of them. And a person aged 40, earning 750,000 Rand per annum, if they generate an 8% per annum compound interest in their income, then by the time they turn 65, they would have generated total earnings of over 50 million Rand. That is a scary thought, because most of us don't even contemplate the idea that we would have earned that kind of money in our working careers. And the biggest problem that most people face is that of underinsurance. And that, of course, creates significant problems. With PPS, your statement of benefits is a mini needs analysis in its own right. I'm not expecting you to read the numbers on here, but the red circle is what we call your gross professional income. That is, if you're in private practice, the income that you generate yourself into that practice, your practice earnings, and if you're in corporate employment, that would be your total cost to company package. That's your salary plus all the value of fringe benefits. And that is more often than not underestimated. In this example, 1.75 million of gross professional earnings per annum sounds a lot of money. And certainly somebody earning 150,000 Rand a month is doing quite well. But in this particular case, you won't read that here, but the insured benefit here on a monthly basis for illness or permanent incapacity is some 60,000 Rand. Less than 50% of their declared earnings in insured benefits. Now, clearly, one's got to ask the question, if something were to happen to this individual, would they be able to survive with their family on half of their earnings? And the answer probably is not. And so that's the issue that we really need to deal with. Looking at where we come from, of course, PPS is 70 years old. We were 70 years last year. And we started off with the defined sickness and incapacity benefits. It's our flagship product, but we expanded that. We have over 200,000 active members, 280,000 in total if we include members that have previously retired from us. And these members work all over the world. We introduced the life and disability cover in the 60s, along with the PPS RA, administered through Sanlam, and that is now one of the biggest funds of its kind in the country. We introduced specialist benefits in 2005, and now we really need to get the message across that we are a full-service financial services provider. We have investments through PPS Investments, short-term insurance through PPS Short-Term, and a full range of life and savings products through that. And of course, all of the profits that PPS generates comes back to the membership tax-free. Now, we haven't got the financial results for 2011 yet. We are busy in the process of finalizing those, so you'll get those probably in the next 2 or 3 months. But this is the amount of money returned back to you over the last 5 years. Over 7 billion rand, almost 8 billion rand of profits that have been returned to you into your surplus rebate accounts in proportion, obviously, to the benefits that you have. And the important thing here that I'd like to pick up on, and I'll get back to it at the end of the presentation after Bruce is finished. An example, a member who's been a member for 41 years, coming to retirement at the age of 65, has paid, in this particular example, 230,000 rands of premiums over his lifetime of membership with PPS. They've had only 97,000 rands worth of claims, but that doesn't detract from the surplus rebate account. But that individual's surplus rebate account at 65 was in excess of R1 million, tax-free. Now that is a significant contribution that has not been premium-based at all. You haven't paid a premium for that. That is literally your benefits coming back to you as a member and if you like, in inverted commas, a shareholder of PPS. So that is a very, very valuable addition to your retirement planning for PPS. And that is a unique proposition for membership. So what I'd like to do, without any further ado, is hand over to Bruce, who's going to talk to us about the retirement planning. And then afterwards, I'll call the panel up and introduce them individually, and we can take questions from you. The presentation is designed to be about an hour long, and then allowing about half an hour for questions afterwards. Thank you very much. Bruce.
Thanks, John. The problem with presentations, good evening, sorry, everybody. The problem with presentations like this is always how to pitch them. It's a problem I have every week in what we put into personal finance and how we write it. Because we know a lot of people know about things and others don't. It reminds me of a story that I heard recently about an appeal court judgment where an advocate was laboriously taking the appellate division through the points of his case. And one of the judges interrupted him and said, "You know, Mr. Advocate, we don't need to be told the 101 of law." And the advocate quickly replied and said, "That's a mistake I made in the lower court, my lord." So if I do deal with things that you already know and understand, I apologize, but I'm trying to take account of the wider audience, and I haven't tried to pitch it too low either. It's quite a lengthy presentation. It breaks into two. And into two main parts. One is about what you need for retirement, what you take, and then the second part is the challenges you face in making sure you retire financially secure. I apologize to the people on that side because I'm going to be pointing to this side when I use the pointer. So if any of you want to move over to this side, feel free to do so. The most important thing about retirement is planning. And it's not planning for retirement on its own. You have to do this holistically, taking account of all the factors that can impact on your life. For instance, the points that John made about being properly insured. But there are lots of threats to your planning. They're from investment, market returns, volatility, living too long. So you have to plan, and plan holistically. As we saw yesterday, new tax proposals which are going to affect retirement planning in a major way. There are going to be more coming along the roads in the next couple of years as well. If you don't plan, you become a statistic. And probably that first one is the worst statistic of the lot. Only 26% of retirement fund members will reach retirement financially secure. That's quite horrifying. Very few, in fact, only about 6% will retire financially wealthy, where they can afford almost anything they want. But to achieve it, you've got to be saving 13 cents in every rand that you earn. And that's quite a challenge. And a lot of people, particularly professionals, think they can put it off until later in life before they start saving. And I'll show you later exactly what effect that will have on you. Basically, retirement planning is about deferring your spending. The less you spend now, the more you'll have to spend later. And it's a matter of balancing those two things up. Like too little saved, you face poverty in retirement. But on the flip side, if you save too much, you're then making unnecessary sacrifices now that you needn't have made and had a lower standard of living. A lot of people say to me, well, how much is enough? I even had somebody come to me the other evening and say, if I've got 5 million rand, is that enough for me to retire on? And I said, I can't tell you. He said, surely you must be able to tell me. You're the expert. I said, I can't, because I don't know how you're going to live. And that's exactly the point, is you've got to start at the end. You've got to decide how you want to live in retirement. For instance, I've got grandchildren overseas. When I retire, I'm going to want to travel overseas a lot more to go and see my grandchildren. But somebody else might have their entire family in Cape Town. So they're the sort of cost differences that apply. So you have to work that out. Now, once you've worked out the sum that you need, you then have to start going back onto how much you earn now. And a lot of what retirement planning now is based on what's called the net replacement ratio or replacement rate. And that basically is the percentage you will earn as a pension as opposed to your final income. So if your final income is 100,000 and you want a replacement rate of 75%, you need 75,000. Simple as that. And I'll be referring a lot to the net replacement rate ratio in this presentation. Once you've decided that, you've then got to work out how much capital you need to support that income, and also take account of the type of pension you're going to get. And I'll deal with those a bit later as well. So it's a matter of just looking at how you're going to end, not what you're getting now and a percentage of what you're saving now. It's what you want when you retire. And this has to be adjusted as you go along, and this is the important reason why you need to plan. There are various vehicles to save for retirement. They basically break up into two: occupational retirement funds, which are sponsored by employers normally, but also by industry groups and trade unions. And then you get individual retirement vehicles, which are mainly retirement annuity funds and preservation funds, although preservation funds you can't add to. They're preserving previous savings that have gone through normally an occupational retirement fund. Occupational retirement funds, the main thing to point out to you is the difference between a defined benefit fund and a defined contribution fund. Defined benefit fund, there's no investment risk for you. Defined contribution fund, the investment risk is all yours, that you can have enough money. The only thing that's guaranteed is that what the employer says they'll contribute to your retirement savings and what you require to contribute to them. And then you get defined contribution provident funds, and that's a tax difference basically. One, you've got to take 2/3 use at least 2/3 to buy a pension when you retire. Defined contribution provident fund, you can take the whole lot as a cash lump sum, but you haven't had any tax rebates on your contributions in the build-up. Dangers of occupational funds, and there are significant dangers. Most of the calculations, and it's done on a equation basically, which is the number of years of membership, average final salary, times a factor, which can be somewhere between 1 and 2 normally. So you're not going to get that net replacement ratio on things like motor vehicle allowances and clothing allowances or housing allowances. It's only on the base salary. So if you want it on the total amount, most retirement funds aim at a net replacement ratio of about 75% of that base salary, not the total amount. Means you're going to have to save a lot more outside of the fund. Then there's this big gap between what you have when you're younger and what you have when you reach retirement age. If you say 30 years old and you've got 4 children, you've only been a member of the fund, say, for 8 to 10 years. You haven't accumulated much in saving, but the insured part of the fund, where you're insured against dying, is only about 2 to 3 times your annual salary. So what you've saved plus the retirement amount when you're age 30 is going to be very much less than what your dependents are going to require if you drop dead at age 30. So it means you've got to look at buying extra assurance. And most people in South Africa, nearly everybody, is underinsured, particularly at the younger age. And this goes back to holistic planning again. You're not going to get everything, so it's a matter of balancing out how much you need to insure for and how much you can afford to save. So all things that come into the planning stage. Then individual retirement funds. Most of you are, most of you, I assume, are members of retirement annuity funds. Currently, you can contribute 15% of your income less if you're a member of an occupational fund of your pensionable income. So if you are employed and you are a member of a fund, you have to deduct that first, and then you can claim 15%. But if you're not, it's 15%, and the good news is that the contributions this level is going to go up, albeit that it's capped. But it only gets capped off when this comes in, probably in 2 years' time. It'll only be capped on earnings above about 1.1 million. So in other words, at the moment, if you earn R1 million a year, you can claim as a tax deduction 150,000 rand against your taxable income. When the new system comes in, if you're under the age of 25, you'll be able to claim 225,000 of the 1 million you earn, if you can contribute that amount, but you'll be able to claim that as a deduction against your taxable income. And if you're over the age of 45, 275,000 against that million. So it's actually quite good news. It got better. It's only those people over earning of about 1.1 million who will then find it capped. Sorry, I think I'm going the wrong way. Yes. Preservation funds are basically there for people who are leaving one fund and they want to preserve it, not withdraw the money and keep it for retirement. You can't add new contributions to them. The products, both for RAs and for preservation funds, you've got basically three choices, and these are very important issues. Life assurance retirement annuities. Now, the old PPS retirement annuity that was done through Sanlam was one of these products. And they were the first ones to come onto the market, by the way, so most people will be in them. I know I was in a few of them, but they were very high cost, mainly because of the commission structures that they paid, and they were also contractual. So if something happened to you, for instance, if you had an accident or you lost your job and you could no longer afford to pay the premiums, you got hit with a penalty of what was called a causal event penalty. And those penalties originally could be very, very high until Trevor Manuel intervened a few years ago and reduced them down to 30%, and now they're down to about 20%. But they're not versatile. The more versatile ones are ones that are basically unit trust based, and they come in two options. One is on what's called an investment link, on a linked investment services product platform, which is basically a administration platform which allows you to choose from a wide range of underlying investments. These can be unit trusts, in some cases they can even be shares. But obviously there's a cost to having the wide choice, but you can put together your own retirement annuity on the way you want it structured. And the other one is just to have some of the unit trust management companies offer a product that just uses their own unit trust funds. Now these last two you can add to, stop paying, whatever. They're totally versatile. The only thing you can't do is withdraw the money before the age of 55, and that's because of tax regulation. So you can't mature it before the age of 55, and then you need to use at least 2/3 to buy a pension. So my view is that the best choices are to go for the unit trust-based ones, and then it's a matter of how wide a choice you want, whether you go for a unit trust management company product or for a linked investment service provider product. Once you retire, you then have to make choices again, and these are on the sort of pension you want to get. If you belong to a defined benefit fund, the fund will probably provide the pension. So if you're a member of the Government Employees Pension Fund, it will provide the pension. The pension has been pre-calculated. You know what it is when you join the fund, and you will get it for the rest of your life. You'll probably get increases with it. The problem, though, is that the increases are at the discretion of the trustees. Most increases on where the fund provides the increases are limited to 75% of your increase on your pension. So gradually you're going to get poorer. You're not going to, because 75% of inflation, you're going to reduce your earning power by 25% a year. There have been even worse cases with defined benefit funds, namely the Transnet Second Defined Benefit Fund, which for the past 8 years has only increased pensions at 2% of the inflation rate. And you're increasingly seeing stories in newspapers about poor, impoverished railways pensioners. It's been an absolute disgrace, in fact, because the Transnet should have made up the difference. But that's a major danger. Then, if you've saved money in a provident fund and you get the cash lump sum, you can buy a voluntary purchase annuity, or else if you've gone into a tax incentivized pension fund or RA, you need to use at least 2/3 to buy what's called a compulsory purchase annuity. The main difference between a voluntary purchase annuity and a compulsory purchase annuity is that with a voluntary purchase annuity, you're only taxed on the investment returns that are paid out as part of your pension. With a compulsory purchase annuity, because you've got the tax rebates on the build-up, you're going to pay tax at your marginal tax rate on both the capital you withdraw as well as the investment returns. Well, having got through that, we're now going to look at the next section, which is, the challenges or threats that you face in getting to a financially secure retirement. And the first one, which was the first thing I dealt with earlier, is the requirement to plan holistically. If you don't plan holistically, you're just not going to get there. And I mean, the very point that John made earlier about not having proper assurance and things like that all have to be taken into account. It's a balancing act all the time. And the only way you can get this balancing act right is with a financial needs analysis. It's a very complex affair. A financial needs analysis will look at all the aspects of your income, how you spend things, what you need, and what is affordable and what is not affordable to get that right. And then once it's done, it's not a one-off affair. You need to regularly have a checkup at least every 5 years, and whenever your circumstances change. And these changes in your circumstances can range from getting a big income increase, from losing a job, from getting married, getting divorced, having children. All those things will impact on your financial plan and need to be taken into account. And it's something that you should do regularly, rather like I go to a doctor to check on my health on a regular basis. I don't want to know that there's something wrong with me. I'd rather know there's something, that everything's going well. And it's exactly the same with a financial plan. It's best if you do find out that you're on target. The biggest single problem to me, particularly among professionals, when I talk to them, is they start saving too late. And this shows you shows you exactly what, these are the ages across the top, and that's your current age. So if you're 20 and you want to retire at 10%, at 55, you need to save 10% in 10 cents in every rand. Now earlier I said you need to save 13 cents in every rand. It is 13 cents in every rand if you want to retire with 100% replacement rate. I'm talking about what normal retirement funds aim at, and that's 75%. So all these figures are aimed at a net replacement rate or replacement ratio of 75%. So the longer you leave it, if you leave it until 35, you're going to have to start, if you want to retire at age 55, you've got to save 22% of everything you earn. And who here could afford to save 22% of every 22 cents in every rand they earn? There are not many people who can do that. And so it gets worse as it goes along. Other problem I find with professionals is that they mistake high income with high net wealth. They are two totally different things. Because you earn a lot, and if you spend a lot, you aren't getting rich. You're the same as anybody else who's just spending the money as they earn it. And a lot of people make that mistake and only wake up when they're about 50 or 55, just before they start thinking about retirement, that maybe they should have saved some of it. And the problem is, the less you save at the beginning, because of the effects of compounded interest, there's a lot more you've got to save at the end. And I'll give you an example a little later. Oops. Other big problem, withdrawing savings before retirement. It's probably the biggest single problem in South Africa, in that people change their jobs, they take the money, and they go and spend it on something else, instead of putting it into a preservation fund. In fact, the position has got so bad that people resign from their jobs, reach an arrangement with the company, and then sign up for a new job with the same company 2 days later. And to the extent that the Minister of Finance said yesterday that that practice is going to be banned. But there's an even worse one. People are getting divorced to get their hands on their retirement savings before retirement. And we can see it because you can see it from the retirement, from the settlements, where the non-member spouse is getting 100% of the proceeds. And they're just taking it, spending it, and moving on, then maybe getting remarried again. But they're definitely not breaking up. I think the smart one is going to be the non-member spouse who just takes the money and runs. Something has gone very wrong with the slide here. Sorry. There's one. Basically, it's a slide that shows that most people start off, if they're members of a retirement fund, able to meet that 75% replacement ratio. But the numbers just drop off dramatically from the age of about 30, showing that people are just pulling out their retirement savings as soon as they start reaching 30 to 35. And so most people are retiring, very few people are retiring financially secure. Don't know what happened to the slide. Other problem, retiring too early. The slide actually shows more than retiring too early. It shows that down under the person aged 20, if they retire at age 60, they will, and this is assuming that they're putting sufficient in to get the 75% replacement ratio. Only down that 20 column do people get to that 75% plus. You can see the incredible difference between retiring at age 60 and 65. Even if you look at the bottom column, look at the top 60 and the 65 to show you how big that difference is. And the reason for this is because you're getting most of the growth that's coming in your retirement savings in the last 5 years are coming from the investment returns on your accumulated capital. Very little, in fact, is coming from what you're contributing. And it's the wonder of compounding interest and compounding returns that works in your favor over the long term in retirement savings. Inflation is one of your big enemies. And very few people understand the effects of inflation. In the old days when people sold life assurance products, they'd give you this figure that looked enormous. But a few years down the line, it's actually meaningless because inflation has reduced the buying power of it. And when you've given a figure 40 years in advance, when you're age 20, it looks phenomenal. But when you get there, you find just how phenomenal it isn't. And this is just a basic example. 1,000 Rand a month, over 480 months, that gives you 480,000 saved. Average return of 8% compounded, that will give you 3.2 million. But the annual average inflation of 10%, your actual buying power is reduced to 340,000. Then those 2 points at the bottom, inflation of 4.5%, about what we've got now, will reduce a fixed pension by 25% every 6 years. An inflation of 7% will halve a fixed pension every 10 years. So it's quite scary what inflation will actually do. I hope the next slide's going to work. No, it's also gone blank. I don't know what's happened to the to the presentation. We found a day before yesterday in Johannesburg. What this one actually showed was also how money runs out because of inflation. And the higher the inflation rate, the sooner it runs out, particularly if we're on a fixed pension. I apologize about the slides. I don't know what could have happened to them. Costs. Also, alongside inflation, to me, a major enemy. It's something that the Minister of Finance has been harping on, and he harped on it again yesterday in his budget presentation, saying he's going to speak to the entire financial services industry about costs and making costs more transparent so we can actually see the impact of costs. A lot of focus was placed on cost after Rob Rusconi, an independent actuary, did a lot of research on it a few years back, and he found that particularly financial services industry life assurance products were very costly and could reduce your benefits by up to 50% over 40 years. So you get 50% less than you would have thought you would have got if there'd been no costs. And those costs are just too high. Now, let's see what happens this time. It's worked. It's come back. This just shows you exactly how costs can dig into it. A lot of people think, 4 or 5%, that's nothing. Well, if you get a 5% return, your costs are 5%, it means you're going to get exactly the same amount of money back that you invested. Okay, if you've got zero costs, you can see that you get 1.5, so you've tripled your money. But obviously you can get, you're not going to get a product which has got no cost whatsoever. To me, anything that goes over about 2.5, 3% in costs, too high. You need to keep costs below that, and that's all costs, total costs. You're just not going to get returns that will counter both inflation and costs on a consistent basis. And that's why you really have to be careful of them. Tax is another thing that will eat into it, but you've got a lot of tax advantages. Most pension funds and retirement annuity funds are based on what's called the EET principle, which means exempt while on your contributions. In other words, you get tax deductions against your taxable income on your contributions. The returns you get are not subject to capital gains tax or income tax, but you are taxed at retirement at your marginal rate. So whatever you're earning, your marginal rate will be that, and you'll pay tax on, as I said earlier, on both the capital and interest withdrawal. But at the same time, you're still getting, on the money you haven't drawn down, a return on what was effectively the taxpayer's money from the day you saved it. So the longer you delay it, the drawdown, the more money you're getting on what you haven't paid in tax. When you actually draw your pension, you also get the lump sum tax-free payments, the first 315,000. Don't think that because it says 18% or the next one at 27% and your marginal rate is 40% that you're going to be scoring. You're not necessarily going to score. And the reason for that is because of that point I made about deferring tax. So the more you draw, you're paying the tax now, rather if you draw it as a pension later on, say in 20 years' time, you only pay the tax on that amount then. But it is worth always taking the tax-free amount, that 315,000, even if you don't need it, just to invest it somewhere else because it's tax-free. If you're a member of a provident fund, you don't get the rebate, so it's called the TET, because you tax on the money that it's after-tax money that you put into a provident fund. There's no capital gains tax, and the new one, by the way, there's no dividends tax either on a retirement fund, whereas previously you were paying dividends on paying tax on dividends earned because it was deducted by the company producing the dividend. Now it's been made exempt, so you don't pay dividends tax, capital gains tax, or income tax at any stage on the returns that you receive on your savings. But with the provident fund, you then taxed when you pull out the lump sum on the lump sum scales that are just above there. Non-incentivized savings products. You've got various. also varies, and so you need to be careful as well in what you go into. Life assurance products, endowment products, there's capital gains tax that's applied 7.5%, and that's applied every year. So don't be taken in by adverts by some of the life companies which say tax-free. What they're saying is tax-free in your hands. We actually had to pull up. I was doing some research on the internet last year, and this advert kept popping up at me saying tax-free investment. Eventually, I got so irritated, I went and looked at it, and it wasn't. It was a life assurance product, which is taxed internally with a 7.5%, and also the 30% tax on interest earnings and foreign dividends. So they are taxed, and the rate, although it looks fine, is not so great, because 30% is most people's average rate is around 30%, and it excludes the interest exemptions that you get. So in fact, a retirement annuity product, a life assurance endowment product can be taxed more heavily than you would be tax saving through a unit trust. When it comes to collective investment schemes, which includes unit trusts and exchange-traded funds, which are also listed instruments, the conduit principle applies. In other words, it's taxed in your hands. So you'll be taxed every year on the interest you receive, and when you cash in a unit trust, if you've made a profit on it, that's when you'll pay the capital gains tax. The income tax you pay on the interest and foreign dividends will be at your marginal rate, and then obviously you'll also pay the new dividends tax as well, or it will be paid on your behalf. Investment choices. And this is probably the most difficult part, where people go wrong because they also make it more difficult than it should be. Just a couple of basic things on investment. The best tax-free guarantee you get is to pay off your debt. Now, someone the other night asked me, does this apply? Should you then stop saving for retirement while you pay off your home loan? Well, to me, buying a house and having a home loan is not really debt. When I talk about debt, I'm talking about somebody I saw the other day in front of me in a supermarket queue who bought a litre of Coke, a packet of chips and a few other things which came to about 50 rand, and he put on the budget section of his credit card. And that is true. I was absolutely shattered as I saw it happen. When you're borrowing money to buy something that improves in value, like a home, that's good debt. So you can balance that off with paying off the debt on your home with still saving for retirement, because it's an asset that improves in value. When it's an asset that loses value and you buy it on debt, that's where it's bad debt. For instance, furniture or even food which you're going to consume. So anything that you consume is bad debt, and that you should get rid of it. And if you have a debt problem, tear up your credit cards, etc., because that's where most people get get out of their depth and debt. Credit cards and store cards. Whenever I see somebody pull out a long queue of cards, I think, oh boy, that's trouble. Best interest rates come from RSA retail bonds, but you've got to lock your money up for at least 2 years. The cheapest equity investment you'll get is an exchange-traded fund, particularly if you buy it on an online share trading platform rather than through an investment plan offered by one of the exchange-trading fund outfits. Diversity of investments is the best solution. In other words, you invest in a wide range of asset classes, so if one's doing well and the other one's doing badly, you're evening out the score. And diversity is required, and I'll deal a bit with it a bit later in the next slide, by Regulation 28 of the Pension Funds Act. And then beware of exceptional promises. The number of professionals that I find that believe in scams and other schemes that offer higher returns is quite incredible. And what I've actually worked it down to, and I don't mean to be insulting, is that professionals often have a God complex. Financial advisor comes along to them and starts telling them things. They don't ask questions because they don't want to look stupid to the silly financial advisor. Who's he after all? So they don't, or more particularly the scam artist. So the scam artists take advantage of it. And it's amazing how many times professionals fall to scams. Some years back, we did an expose of a certain gentleman called Jack Milne, who started his own investment fund and didn't tell anybody what the contents were. We challenged him over 4 weeks on it, and he took us to the Media Council. He won his case against us because he lied to the Media Council, and he went to jail for a year for his part in the scam. But when it all collapsed, I had a phone call from an accountant in Pretoria who said to me, he's got a massive problem. I suspect he'd put 8 million rand, which he spoke about, of other people's money in his trust funds. And that's why I could literally feel him sweating over the phone. And he said to me, what can I do? I said, well, there's nothing you can do. You've lost the money. And I said, but you're an accountant. Why did you put your money there? If you just read the prospectus, you would have seen that this thing was hollow. And Alan said, we wrote about and warned about it. Did you read what we wrote? Yes, he did. So I said, why did you invest? Oh, Jack was such a good guy. So, you need to be very cautious and always ask questions. Your savings in a pension fund, a tax incentivized pension fund, and even a provident fund are determined by regulation, are subject to what's called Regulation 28. What Regulation 28 does, it says that your savings must be diversified across asset classes. I recently saw one company that doesn't offer retirement annuities, a unit trust company, say don't invest your money in retirement annuities because you're going to have to invest in low return investments. That's absolute nonsense. What it does, the Regulation 28, it has limits, yes. But for instance, it has a 75% limit on the shares on shares. So you can't invest more than 75% in general equities. However, you could still be 100% invested in equities because there's a separate section for property. So you can be 25% invested in property shares and 75% in the whole lot, which is a more volatile sort of exposure. But when you're younger, you want to be exposed to something that gives a higher return. But Regulation 28 doesn't stop you from investing in a higher risk return. Most pension funds, for instance, I'm a trustee of 2 pension funds, and we have a policy of not allowing our asset managers to invest more than 66% in equity. So we're even more conservative than Regulation 28. But we have very sound reasons for it, because we've gone back and looked historically at the performances of all the asset classes, and we've then tried to get the best risk returns from that by looking at things historically. So don't be scared by it. It's there to ensure that you spread your investments. Don't put everything into one high risk thing, because the government doesn't want to have to pay you the social pension of 1,000, I think it's gone up to 1,400 rand a month, or somewhere around there, which if anybody feels that they can live on it, go into the single high risk investments. The dangers, and it comes back to scams and bad advice and bad products. Now, I put this list together in a very deliberate way, because you'll see that there are scams like Master Bond, pyramids like Rainbow and the Kubis Milk pyramid that was very popular in the Cape Town area some years back, to the bigger scams also like Potentia. But in that list are also companies that you would have thought at the time, like Fedshaw and Sambo Bank, were above board. So you have to be very, very careful in your choice of product and product provider, because even those that may seem to be fine are fragile. And there are giveaway signs. For instance, with Fedshaw was offering way above guaranteed pension rates and other life assurers. Now, people went to Fedshaw because they thought they were getting the higher rates, but it imploded, and they didn't get it. And in fact, it imploded so badly that the building sector retirement funds were all with Fedshaw, and they lost 12% of their savings. Now, if you just a day before retirement and you lose 12% of your retirement savings, that's going to have a hell of an impact on what you're going to get as a pension. So you need to be careful. You have to balance things all in investments. Inflation, returns, greed, fear. That's one of the big problems in South Africa too, is people all climb in when their secretary starts buying rented property, always at the peak, and then they're forced to sell when it drops, or they then get scared and panic sell at the bottom instead of doing it the other way around. You've got to look at what tax versus what tax. So in different products, how they tax differently. Whether you're being too conservative in your investments, because being too conservative, you took all your money and put it in the bank and left it there, you're going to get back less money because inflation and low interest rates are going to just dig away at your capital. Whether you want to invest in passive investments or actively managed investments, very few active managers get it right on a sustainable basis. Passive will not give you the results that those that do succeed, but you're going to get the average, you're going to get the market average. So you need to look at all those things and decide what you want. And also active costs you more. So you've got to take that off the returns that the active manager is going to give you. A big danger in planning, and it's a danger that's made by everybody, financial advisors, product providers, and it's made in various ways. The biggest area it's made, there are two areas where it's made, and I'll deal with both of them. One is on when you expect it to die. They take an average there. And the other is on historical returns. And markets vary all the time. They go up and down in that order, always. So if you took somebody who was 10 years away from retirement, and this is some very good recent research done by somebody from Cape Town called Daniel Wessels, who's done a huge amount of research over the years on retirement. I mean, we've used a lot in personal finance, particularly in the magazine version of personal finance. If you took somebody 10 years away from retirement in 1998, they could expect a replacement ratio of 8 times their pensionable salary. But somebody who was 10 years away in 2008, after 10 fantastic years of market returns, they could expect a 14 times pensionable salary net replacement rate. And that is not because anybody did anything different. They had exactly the same amount of money. They saved exactly the same amount of money. And this next slide, if it has worked, will show it even better. Now, this is looking at drawdown rates of an investment-linked living annuity, where someone's considering the outcomes on both. This is what's called a Monte Carlo simulation. That beginning point of 1 million is actually at numerous dates over a number of years, a month apart. So every line is the same amount of money, but it's invested at a different time, 1 month apart. Now it also shows the effect of a high drawdown rate to a low drawdown rate. The red ones are where there's a drawdown rate of 8%. In other words, they're taking 8% of the capital every year. On the other one, it's 6%. Now, obviously, the person drawing down 6%, their money is going to last longer, and you can see it with the blue lines. But look at the difference between, on this blue line here, which is the best outcome, the person's money would have lasted to 105, as against there, where it would have run out at 80. And that is just from the differences in performance over different periods, investment performance. So you can't sit down and say, because shares have given a return of X% over the last 40 years, that they're going to do it for the next 40 years. You have to look at what they could do on the upside and the downside. And the more you can plan for the downside, the better. Because if you can so easily run out of money. And most people will just give you that average over the years. And the other problem in retirement, when you're in retirement and you're drawing down, if you draw down when markets are down, it's going to take you twice as long to recover your position than it is. So you have a bigger problem in retirement than you have in just the build-up of your savings. Product choices. There are huge product choices and huge differences, and it's again why you need advice, so people can tell you about these products and what the differences and why one will suit you and why one won't. I mean, guarantee, just taking example of guarantees and no guarantees. If you get a product that's got a guarantee, it could have a more conservative investment portfolio and it will have a guarantee charge. Whereas, so you don't really want to have guarantees when you're younger. You can ride out the ups and downs. But when you get older and closer to retirement, you probably will need those guarantees. And the same applies when you buy an annuity as well, what type of annuity you buy. But you need to know what the effects are on you. Capital guaranteed index-linked products, these are what are called synthetic products, because they don't actually invest in the underlying index that they say they're tracking. And to me, there are huge dangers there, just as there were huge dangers in the subprime housing, because all of these synthetic products are banks. Banks are borrowing money to gear up the investment so they can meet the guarantees. And there's huge exposure, and I'm pleased to see that it's now become a focus of attention in the Basel discussions on risks that are in the financial services industry worldwide. But even then, the products can be so different. If you get a structured product, it might exclude the dividends on the index, whereas if you're in a non-guaranteed product, you're going to get the dividends. So you need to look at all those sort of things. But the important point, and it goes back to the God complex, only invest in what you understand. There is no such thing as a stupid question. And when we see new products come at us, I sit there I'll have the product provider sit in my office for half a day while I question them and re-question them until I understand the thing perfectly. If I need to do it, all of you need to do it. And that's the biggest single thing. Understand these products and what they are, the ups and the downs. Now this is the other problem, a major problem for when you reach retirement, and it goes back to my problem about assuming things based on past experience. And the most important one of this one, as of the last point to me, is that the first person to live to 150 is already 50 years old. And that assessment was done 3 years ago. So, it's one of you. Might even be me, I doubt it though, but you cannot make assumptions that you are going to die at a certain age. Now, most living annuities are calculated on a person dying at age 84 to 86. Well, that's an average. For every person who dies 1 year before 84, 86, there's one that dies later. So you must take that into account in your calculations, unless you're a Sicilian actuary, and I'll quickly tell you the difference between a Sicilian actuary and an ordinary actuary. An ordinary actuary will give you the probability of the age you're going to die. The Sicilian actuary will give you the time, date, and place. Then you have the flip side of that, and that's dying too soon. And that's what John mentioned and what I mentioned earlier, is that you've got to take account of what will happen to your dependents if you die before you reach retirement. Or, even more importantly, what happens if you're disabled before you reach retirement. Because disability, I mean, I know you've got a great plan with PPS, probably one of the better plans on being disabled, not being able to work. But it's a problem. People just don't work this out. They think they've got enough, but it goes back again to planning. But also, don't over-insure. I mean, things like double indemnity. If you die in an accident, you get paid double the amount. If half the amount was sufficient, why do you need double the amount? I mean, that's just over-insuring. It's just stupid. Like insuring your little toe or something when you're not a ballet dancer. A good example to me is insuring to cover your own children. Child's born, you've got a savings target of, say, 150,000, probably more like 1.5 million in 18 years. You die after 10 years, you've only saved 60,000. You need life assurance to cover that difference. But then comes a point you don't need too much life assurance either, because say you died after 15 years and the shortfall's only 10,000. But you're still insured for the full amount, you've got too much insurance, you're wasting money. So life assurance is not there to make dependents rich. Compare premiums and compare the structure of a premium. There is a lot of mis-selling of life assurance going on at the moment, where the premiums appear to be low, but the future premiums are going to be much higher than they would be. You must look on guarantees on premiums. We did a major story on it last week in Personal Finance. You can, if you go to our website, which is www.persfin, P-E-R-S-F-I-N, you can see all the variations that we detail, and it's worth looking at. Important point is don't try and hide things, either about what you do or health. The number of cases that I've seen where the life assurance companies have refused to pay out, and they're entitled to pay out because they've been misled, is enormous. I know a lot of you in this audience are doctors, and you'll know the life companies come back to you and check on what the person's condition was, what treatments they were receiving, and if they find that they've been lied to, bang, that's it. So your dependents are left with nothing. Another danger, and this comes after, or another challenge, comes after retirement, and that's choosing the wrong annuity. Now, the most popular annuity at the moment is an investment-linked living annuity. And the main reason why I think people are buying them is because, well, there are a couple of reasons, but your pension lives after you. In other words, you're taking into account that you want to leave money to dependents. That is not a good reason to choose a living annuity, because you could quite easily run out of money because of various bad choices like investment choices or drawing down too much before you die. So the choice must be made on yourself, on how you want to live, on what sort of annuity, and how long you want that annuity to last. And it's interesting that at the moment, if you look at guaranteed annuities, now these are ones that life insurance companies sell you, and I've just worked on a level annuity. A level annuity, by the way, is not one to choose, but I was just doing it so I could show you the contrast, because inflation will eat into a level annuity. You need one that's linked to inflation. You'll get less when you start off than a level annuity, but the amount will increase in line with inflation. Eventually you'll get more after about 6 years than you would have got on a level annuity. But this guaranteed annuities are mainly a function of age, gender, and interest rates. Age, because they'll pay you more the sooner, because the older you are, the shorter the time they've got to pay it. Gender, women live longer than men. Men die earlier because they want to. And interest rates. If interest rates are low at the time, because most of the money is invested in interest-earning investments, so if interest rates are low, you'll get a low return, and then it's locked in for the full period. But as you can see the effect of age on it. So when you get to about age 70, the returns you're going to get, and they're guaranteed returns, and the implied yield, get far better. And the other thing is that as you get older, your capacity, your mental capacity to manage a living annuity becomes far more difficult, particularly if you're suffering from some sort of dementia, as often happens, particularly with people living longer. So don't discard guaranteed annuities just because at age 60 they might not look like the good option. At age 60 they might not be, but later on they will be. Sorry. Important thing, advice. Advice can be a double-edged sword, as I say, because there's good advice and there's bad advice. The law has been toughened up, the qualification requirements are being toughened up, and things are getting better. But there's still rogues out there. Those are the people who sold things like property syndications and things like that. And the reason they sold it was because instead of getting an average sort of commission level of about 3%, some of them were getting as much as 15% commission. Well, as soon as somebody gets a 15% commission on an investment product, you know there's going to be no return. It's got to fail, apart from what was being swindled out of it by the promoters of those schemes. And most of them, all the big ones, have now imploded. And those financial advisors that sold them are all running for cover because a lot of investors are coming after them. But advice is essential. It's a matter of choosing your advisor correctly. It's like going to a doctor. If you don't know who to go to, you speak to your friends. You ask them about what sort of service you've got from them. If you walk into his surgery, he's got a bottle of whiskey on his desk. Flee. Same things, sort of things you must do in assessing a financial advisor. But it's a complex world out there, finances. And if you don't get it right, and because you don't think you need advice, the chances are that you're going to land up not getting it right. As I said, there's a lot more regulation now, and it's going to get better. There's something called treating customers fairly, which is going to put a far greater obligation, particularly on the product providers, to make sure you're properly informed and treated properly. Probably the question we get asked more often than any other question in personal finance is, where do I find a good advisor? Well, we can't give a recommendation on any particular advisor. It would, in case something went wrong, and you'd come and sue us. But what we do is we refer people to the Financial Planning Institute. Now, the Financial Planning Institute can accredit what are called Certified Financial Planners, CFPs. They are well educated. They have to get a postgraduate qualification, either from the University of Stellenbosch or the University of the Free State. I think there are a couple more coming online. And they have to sign a code of conduct, which they have to adhere to, or they get kicked out. And to me, that's where you go looking for a good financial planner, is from the FPI. And their website is on the presentation. By the way, you will all be sent an email tomorrow by PPS giving you the web address at which you can download this presentation. Go to that website, and there you will find a good list of financial planners. Be prepared to pay for it. Advice, they have to live. But my view is pay somebody a fee, because if it's an advisor working on a commission-only basis, they've got to sell you a product to live. But if your finances are fine, why must you buy a product? You know, you want to be told, as I get told by a doctor when I go to a doctor, that my health is fine. Exactly the same principles should apply with a financial advisor. They spend a lot of time studying, they spend a lot of time researching products. They need to be paid, and paid adequately. But I would say the best way to pay for it is on a fee. It's a long list I've got here of what a good advisor should do for you. I'm not going to go through them. You can read it if you download it. But they basically have to give you appropriate advice that's appropriate for your needs, not for Joe's needs next door, but for yours. And if you follow all that, you won't retire to one of those benches. Thank you very much. That's the end.
Thank you, Bruce. Ladies and gentlemen, what we'd like to do now is, if you please have questions, please write them down, because it makes it easier for us to collate those questions and answer the ones that are sort of more generic. We have people walking up and down the aisles. There are forms on your chairs, so please fill those in. A few minutes, if I can please ask the panel to join me up on the podium. In the meantime, and if I could just introduce them. Chris de Klerk is the PPS Corporate Actuary and Executive Director of PPS. Thanks, Chris. Tinus Ferreira, Advocate Tinus Ferreira, is BA LLB and is the Principal Officer of the PPS Retirement Annuity Fund, as well as the PPS Staff Pension Fund. And Nick Battersby is the Chief Executive Officer for PPS Investments. Welcome and thank you. I'll also join the panel, and one of the things I think I should also point out is that Tinus, Nick and myself, Chris is an actuary, so he's got far more knowledge than any one of us. We're all certified financial planners in our own rights, and many of the people that we deal with are intermediaries. We go through a very rigorous process of selecting our intermediaries. I must say, unfortunately, it's not infallible, but it is a fairly rigorous process, and the vast majority of our licensed and accredited intermediaries are as well certified financial planners. So with that, if I can please ask the people collecting the questions, if I could get those, but perhaps if I could kick off, Bruce, whilst we're doing that, and perhaps just ask you a question very simply is, and pertinently, yesterday was the budget speech. You did mention one or two things earlier in your speech around some of the implications for individual retirement planning from the budget speech yesterday. perhaps if you could make a few comments on that, if you will.
Overall, I think it was quite a good budget. Obviously, he's whacking the rich again. I looked up some figures in one of the brochures they gave us, and of total number of taxpayers, of which there's 6 million, 1.7% earn more than 1 million rand, and they pay 24% of the total tax. That's the personal income tax that's paid, which shows how the rich do pay up a lot more than those who are poorer. And there are various caps. Even this cap now that's been placed on retirement fund contributions and what you can claim as a deduction, it's very, very high. If you only at the moment can only claim 150,000 if you're earning $1 million, and that goes up to 225,000. That's quite a jump up, and it's actually quite helpful, particularly for professionals who often start saving for retirement later. But one thing, to me, the most important thing of this budget, from an individual point of view, is what they've done to retirement funds in general, and that the dividends tax doesn't apply to it. And it means that every one of you is going to have a look at how you're investing, because you're going to pay that dividends tax if you go into discretionary investments like buying shares or unit trust funds, whereas you're not going to pay that dividends tax if it goes into retirement annuity. And things like the PPSs, and I'm not endorsing the PPS product by any means, becomes an attractive option because of the tax structures, rather than putting money into a discretionary investment. So there's a lot. We're going to deal with a lot of it over the weekend from an individual point of view in personal finance. So a free advert, go by the Weekend Argus this weekend, you'll find personal finance in it on Saturday.
Thank you, Bruce. Question for Nick. For PPS intermediaries, is there a prescribed fee structure allowed for PPS RA products?
That's a nice question. There is a prescribed maximum advice fee that we allow the accredited advisors to earn and to negotiate with you as clients on an initial basis and an ongoing basis. We found that some of the traditional products have had very high fee models, and often those fee models were not understood by clients. So in the modern generation products, of which we are one, you'll find you actually can see very crisply exactly what you have paid in your advice fees, in rand terms and percentage terms. And there's a maximum initial amount and there's a maximum ongoing amount, which are on the application forms.
John, can I just add something?
Thank you.
All fees are negotiable, not only the fees of advisors, but even the company product fees are negotiable. But difficult sometimes, but if they're larger amounts of money, they are negotiable. Sorry. I hate the word maximum.
A question for Chris, a good actuarial question is, Chris, life expectancy clearly determines the required rate of saving and acceptable drawdown rates. What is the life expectancy today, and how fast does this increase?
Oh, that's a very good question, John. Bruce alluded to it earlier. I think the life expectancy today is 84, but when you get to the age of 65, it quickly ratchets up to closer to 90. So it is difficult to estimate, and it's increasing rapidly. I think there are different parts of the population that have different age expectations. But I think 90 is the new 70, I think.
Okay, good. I know one of the old cliches is the older you get, the longer you live. Bruce, probably a question that's on everybody's mind. Your view on the effect of the Social Security Scheme, the National Savings Fund, on retirement annuity planning?
I think it's a good thing. You might well be horrified by that statement, but I think it's a good thing because if we don't do things about getting rid of the immense poverty in this country, it makes way for a revolution. It lays the path for a revolution. And if you think that at the moment that the social security, social old age grant, which is about 1,300, 1,400, I think it is now, gone up to, and 5 people on average are dependent on that in South Africa, on each payment, because it gets given to the grandparents are supporting children, often because of parents dying because of AIDS. It's a problem. And The other thing is that at the moment, people, particularly on the lower incomes, they've joined provident funds, they take the money and they spend it. We need to have a system where people can also accumulate wealth, and that's what the National Social Security Fund will do. It will help people accumulate wealth. But it's only a first stage of retirement. Even though we might all be forced to become members of it, it only aims at a net replacement ratio of 40%. So you will still need products to get the balance. But the government talks a lot about social cohesion and everything else, and balancing it out. It's part of the penalty of being more wealthy and earning more and being better educated, that you've got to help the poor in society. It's a principle that's established right around the world. That's it, John.
Thanks, Bruce. Another question for you, Bruce. How realistic is the defined retirement age of 65, considering that someone aged 30 could well live to 100?
Well, I'm scheduled to retire in February next year. I don't feel like 65. I have to retire. I have no choice. But there's no way I intend to stop working. So I just think it's crazy that the rules of funds that say you have to retire at a certain age. I mean, I think people should retire when they're wealthy enough and when they feel like retiring. I don't feel like retiring. I haven't been nasty to enough people yet.
Yeah, I think comment on that in terms of what we find as, from our professional membership is that the average professional works much longer than the normal employee type of person for two reasons. One, because they can, and often because they have to. That's an interesting thing that we find often. Two questions, Nick, relating to section Regulation 28. Do you have to rebalance this portfolio annually? Do you have to keep looking at it regularly in terms of what you've chosen in Regulation 28? And also, similar to that is the sustainability of Regulation 28 for a younger investor who has a high-risk profile. What would your comments be?
I think on the second question, I think Bruce alluded to the answer to that one. Regulation 28 did not enforce you to be in a more conservative portfolio. As Bruce said, you could in fact have 25% in property shares and 75% in general equity shares. So I don't believe, and I think Bruce alluded to the fact there are some companies that surprisingly don't offer retirement annuities who've been building a case that Regulation 28 depletes the value proposition of a retirement annuity. So I wouldn't agree with that. In terms of whether you have to rebalance every single once a year or once a quarter or more frequently, there's quite a lot of debate at the moment between the industry and the regulator. The intention of the regulator is certainly that they would like there to be some conscious monitoring of Regulation 28 at member level, but there are some complications around that. So the industry is busy debating with the regulator whether in fact there'll be a need to force rebalance, or whether portfolios that have become by market moves non-compliant, in other words, they've got too much equities, for example, more than 75%, whether there'll be some restrictions on future transactions. So there's initial guidance, but there's still clarity that is required at the moment, and the ASISA as the industry body is actively engaged with the regulator in that regard.
Thank you, Nick. The next question probably for either Nick or Tinus. I think perhaps give Tinus a bash at this one. What would your opinion be about instituting Section 14 transfers for retirement annuities, for non-performing retirement annuities? Is it better to do a Section 14 transfer or to make it paid up and start something anew?
I don't think it's really going to matter whether you make it paid up or whether you transfer to another fund, because in both cases, if you want to transfer from a traditional fund where your money is invested in an endowment policy, there will be termination charges. Whether you terminate the policy or simply transfer to another fund, the termination charge will be levied, because what you are doing in effect is you're terminating the policy, which is underlying the investment. So generally speaking, transferring from one fund to another is not a good idea. You've got to do a careful calculation to ensure that the growth that you will receive in future can make up for the money that you've lost due to the termination charge. And our findings are that about 80% of people who get quotations from the relevant insurance company, when they consider a transfer, eventually decide against it, because the termination charges are of a punitive nature.
John, can I just add one thing? If there's an escalation clause attached to that the old traditional RA, you should cancel that. There's no penalty for that, and then rather take the money that you were going to pay in the escalation and put it into a new generation product.
I think as well, the comment, Bruce, that you made earlier is very pertinent, that a lot of people cancel out of these long-term savings plans just before the value of compound interest starts to really kick in. So you really need to look at them. In my experience, in terms of keeping these older type products, if you do keep them for as long as they are supposed to run for, because then you amortize all the costs and you do get the compound interest effect on that. So don't be too tempted to rush out of them too soon.
That's an important point on the cost, because it costs even out over the entire period.
Yeah. The earlier you get, the more costs you get lumped up front. That's why you get the penalties, because an insurance company on those older products, and some of the other forums that we've had, they've asked the question, why are these products still around? Well, the reality check on that is, in the old days, in the 60s, when these products were first implemented, this was what you got, and it was revolutionary at the time. So obviously, as things improve and technology improves and people become more sophisticated, like buying a motor car, you actually get the best and the improved versions, the longer you wait. Does that mean you should wait forever? Well, if you do, you won't have any savings at all. Bruce, a question which is quite an interesting one given your comments about commissions. It says here, what in your opinion would be a fair price to pay for a fully qualified financial advisor per hour?
Well, the other day I took my dog to the vet. I'd say that's a good starting point. 800 Rand consultation fee. No, I joke. I don't know. It's difficult. It's something that you've got to discuss with your advisor up front. I mean, the amount of time that's taken, for instance, in doing a financial needs analysis, the advisor will ask you for all sorts of details about your finances. I'll then take those details and go and analyze it. And this can take hours to do a proper job. And then you've got to look at the products. That's research that the person's having to do anyway all the time on an ongoing basis. So, it's an hourly rate that should be settled on. And what's a reasonable hourly rate? I don't know. What does a lawyer or a doctor charge? I heard a lovely story the other day of a lawyer who died and went off to heaven, and he met St. Peter at the gate, and he said, "Why was I taken so early? I was only 32 years old." And St. Peter said, "But I checked your billing hours. You're at least 110. So, I'm not sure. It's something you've got to, the advisor should come up with a figure, and then you should negotiate around that figure. Because different advisors are going to need different amounts. I mean, it's about how good they are. I mean, for instance, if you go to a specialist or a GP, the amounts that you pay, and the same will apply to an advisor. I really don't know. There are no scheduled rates. It's against the Competitions Act to do that. So it's a matter of negotiation.
Perhaps, John, if I may, I'd like to turn that question round from here to all of you. There's a lot of work going on in the industry again at the moment around intermediary remuneration to outlaw some of the problematic practices of the past that Bruce alluded to earlier on. And one of the issues there relates to the mechanism with which an intermediary can be rewarded. You wouldn't expect your medical practitioner to not charge you anything but to claim a fee from the medicine provider. But how many of you, by show of hands, have ever paid an invoice to a financial advisor for their services? Maybe 10. How many would? Okay, that's encouraging, because the perception has been that, by and large, there's this negative perception historically about the quality of advice, and therefore paying somebody for their hour has been a problem. So that's a really encouraging indication. The appetite is stronger than the precedent, but it's encouraging.
I think one of the conundrums, and you'll probably all have heard this before, is that insurance products are sold rather than bought. Nobody wakes up in the morning thinking, oh, I think I'll go and buy some life insurance today. Or what if I drop over and get run over by a bus today? These are things that we don't think of or prefer not to think of. And so the issue, I think, historically has been that insurance people are generally considered to be pushy. And in some instances, the pushiness of an insurance people has helped a widow. But I think in terms of the professionalism of the industry, it's critical that this industry raises the bar of its own reputation. And I think CFP goes a long way to doing that. Bruce, 2 questions relating to Satrix. How would you rate the Satrix as something like an RA?
Satrix is not an alternative to an RA. Satrix can be an underlying investment with some RAs. An RA is a tax structure. What you've got to compare, I'd rather use the term exchange-traded fund, which the Satrix funds are, which are passively managed funds. In other words, they just track an index. And you get various indexes. There's a whole wide range of them, an increasing range of exchange-traded funds and exchange-traded products now. I personally invest discretionary money in exchange-traded products, and the reason I do it is because I don't have the time to sit and research investments, and I'm getting the market average, so my risk is reduced, and they are very, very low costs. I buy them off an online trading platform. If you buy them through an investment plan, they become a bit more expensive. The costs can be about 1% more than you would otherwise have paid. I think those investment plans are too expensive, and the costs need to be brought down. But it's another investment option, and it depends on how you feel about it. You know, if you prefer an actively managed, multi-managed fund where somebody's making the decisions for you, there's nothing wrong with that. It's just how you see it, and I've got such a thing about costs of financial products. It's one of the reasons why I do it, maybe even if it counts against me.
Thank you, Bruce. Tinas, question for you. Why has PPS not been more creative about negotiating termination costs if one moves from the old Sanlam RAs to the new generation PPS RA? That's why we're here.
The point is there is no room for negotiation because these termination charges were included in the policy contract right from the start. And then, as you've heard from Bruce, quite recently the legislature intervened and started prescribing maximums. And it is very difficult to go and say to the insuring underwriter that you should charge even lower termination charges, bearing in mind that they do use statutory actuaries to calculate these charges. And then I also have to add that I have to sign all these transfers. So I look at the figures. And lately, in the last 2 years or so, in the majority of the cases that I sign off, the amount charged by the life assurer is way lower than the maximum prescribed by the legislation.
Thanks, Tinas. Bruce, is it still possible to purchase second-hand policies, and what's your view on that?
Yes and no. Yes, you can still purchase them. No, don't. And there are numerous. There are a lot of scams going on in that area to start off with. And the other thing is you can be subject to triple CGT on them. It's just not worth it. And it's just so opaque, that whole business. There are some companies like Old Mutual, I know, which have a second-hand division where they actually auction the policy off if you're selling it. But it's being bought by somebody else who's going to try and make a huge profit in selling it to you. I just don't think they're worth it. I think they're too opaque. I think the tax problems, and I don't think you're going to get the returns that a lot of people say you'll get.
Thanks, Bruce. General savings question. I think to the panel here, perhaps Bruce, but you're getting all the questions. But then I guess that's why you're here. Why do you think that interest is still taxed, especially as we're continually being encouraged to save? Is the situation likely to change?
Well, interest is an income, you know, so everything that you earn should be subject to tax. I don't know whether to say it's good news or bad news, but the exemptions on interest earnings are going to go in the next 2 years. They're going to be replaced by a different type of savings product, where all the returns will be tax-free, but there'll be limits on it. It's aimed at short to middle term savings. But anything on which you earn a return as part of your income, it should be subject to tax. But it's at a preferential rate, because you get the exemptions.
Good. Thank you, Bruce. Chris, a question for you. Why does PPS penalise you on your SRA payout when you retire early?
Good question. The SRA account, I think what's important to understand about it, that is the working capital of PPS, and that's the benefit you get, the sharing of the profits you get of PPS when you retire. So it was never intended as a short-term investment or as a policy benefit payable before retirement. I think if people do cancel their policies before retirement, there's a portion of that that's available to them, but SRA has always, since the beginning of PPS, since 1941, been the working capital of the business that allows us to run the business. With no external shareholders, it's important that we have that capital available.
Thanks. Thank you, Chris. I think just to start wrapping up, the question here, can a discretionary annuity be a living annuity?
Pardon?
Can a discretionary annuity be a living annuity? I think, because in other words, I think that's asking is a voluntary annuity perhaps be a living annuity.
By another name, it becomes an income plan. So it's much the same thing. It's just a tax difference. One income plan, you're only being taxed on the investment returns, not on the capital amount that's being withdrawn.
And a more general savings question as well. What are the best vehicles for general savings, children's education, such as that? And if you go for the unit trusts, should it be put into your parent's name or in the child's name?
Is that to me?
I think so, yeah.
I have grandchildren, so I was recently addressing that. I think it's best, you can actually get products where it's in the child's name. Most unit trust investments, for instance, you can take it out in the child's name, but the parent then controls that account. I've just done it recently for 2 grandchildren, and that's how I did it. So you can do it either way, whichever, if you don't trust the parents who are your own children. The trouble is that, as a grandparent, you're probably going to die before that child will benefit from it. I mean, depending on the age the child's at and how old you are.
Just one additional benefit of that is we obviously, when you listen to that question, you're thinking about an infant. But I would always suggest putting the child's name, simply because when that child becomes a teenager, they're receiving the statements, they're receiving the documentation, they're becoming financially literate, and you're inculcating them with a savings culture themselves at a young age.
With my children, by the way, what I did, I said to them, for every rand they saved, I would meet that rand. But for every rand they withdrew before the age of 18, I was going to withdraw 2. Worked like a charm.
Yeah. Excellent. That brings us to the finish of most of the questions that we've received up here. So if I can please ask then for you to join us outside for some drinks and snacks. And if you have questions of an individual nature, please be aware that our people are outside available for questions. And of course the panel will be mixing around as well. Thank you very much indeed.
Thanks.